What's going on, guys? Mike here, and welcome back to the channel. Today marks the very first video that I'm doing for 2024, so I hope we started out right. I do have a few requests from a few subscribers that they wanted me to kind of go over my investments into my REITs. And for anyone that's new here, I have currently 3 REITs spread between my TFSA and RSP, which is Plaza REIT. We also have SmartCentres, and we also have RioCan. So I'm going to be just kind of going over how they performed this year, what their payout ratios are, whether I believe that they're safe or maybe that they're at risk. So we're just going to skim through the Q3 of their financial reports. We will be shortly probably seeing their Q4s, which we'll also recap in a later video. So I want to go over just maybe some potential changes that I may be doing in 2024 in regards to my REIT exposure. So I'm going to go over that as well. So let's just kind of get right into it. So you'll see here, I do have my recap of 2023 year-to-date performances, and I just kind of wanted to highlight the REITs, right? So again, I have Plaza REIT that came in at a negative 5.8%. I did have SmartCentres that actually overall got 1.4%, which I was actually quite surprised with, and RioCan coming in as well as a negative 5.8%. So just kind of kicking it off, just kind of on the Plaza REIT website, just for all the new viewers here, Plaza REIT is kind of your small to medium size REIT. I think they're about like a $400 million kind of cap. So nothing super large compared to like RioCan or SmartCentres, but they are kind of like my OG REIT. This is the very first REIT I bought into. I quite like them. When I first bought into them, their payout ratio is like, I think it was like high 50s or low 60s. And they were paying about 7%, and they kind of just seem to be somewhat more of a safer bet, where like their stock price just kind of always stayed between $4 and $5. And today they're sub $4, but yeah. So like I said, I was just kind of capitalizing on that real estate income of that 7% annualized, and not necessarily paying too much attention to capital appreciation. Now, of course, I don't really want it to lose capital, but we're going to kind of go over what people have potentially done in the year of 2023 with how much real estate has gone down. I've stayed to my plan, but we'll get into that here shortly. But just like I said, as a quick recap, they currently have 233 properties spread across Canada, and they are just Canada. They don't have no international exposure. So they do have quite a few developments underway, and like I said, their distribution is 28 cents annually. So I think that works out to be around that 7%. I haven't done the math, but so it works out to be like 0.02333 cents monthly. So I guess if we would just want to see a quick calculation as to what they actually are getting, we do 28 cents, 369. So yeah, they're actually paying out just under 5.6%, which is really good. So just kind of going into their actual financials. If you're new to the channel, the one metric that I always pay a lot of attention to is their distributions payout ratio, right? So you'll see in the September 30th of 2021, they were in and around that 73.9% for the last 9 months. In 2022, it increased to 84.3%, and now we are in the 9-month end of 90.8%. So they are on an increase, which is obviously concerning. If this gets too much higher, we could potentially expect to see a reduction in their monthly distribution, which would be upsetting. But they are paying upwards of 7.6%. Even if they were to reduce it down to somewhere between 5 to 6%, I do think it would probably be a good thing just to kind of get their payout ratio back into that 70s or low 80s. but then start retaining some of that cash flow to, you know, pay off the debt that obviously is going to be costing them more today compared to, say, 2021. And then, of course, what we would see from that is, you know, if we had a 5 to 6% dividend, we would probably start to see that capital stock price actually start to increase again, right? So right now, I think it was $3, and well, right now it's $3.70. So yeah, so it's not necessarily always a bad thing to see a reduction in the payout, but it is obviously a kick in the teeth a little bit when people are definitely relying on that monthly income. The other thing I always try to pay attention to is obviously the revenues. So this is obviously their income in regards to rent. So we do see, which is what I want to see, an increase, right? So in 2021 we were at 83 million. 2022 they actually were stagnant at 83 million, and then this year, again based on numbers from September 30th, they were at 85 million. So that is a good sign, you know, and that's basically happening due to leases expiring and renewing at higher costs. So that's typically what will happen is when when inflation goes up, costs of everything goes up, you know, with interest rates and everything. They will start renewing their rental agreements at a higher rate. So over time, their income will be higher than the years before, you know, assuming if everything is going right. So now moving into SmartCentres. This particular REIT, again, if you're not familiar with them, are primarily located in like the heart of Toronto downtown. They have, you know, the skyscrapers and, you know, all those fancy buildings. So they are very concentrated into Toronto, which can be a good thing or also a bad thing, depending on what you're kind of looking to get out of the actual REIT. So looking at their payout ratio, looking again at the 9-month, so September 30th, 2022, we were at 95.6%. And then moving into the September 30th, 2023, we are at 97.6%. So this does start to look somewhat concerning. Their payout ratio, obviously, once it exceeds 100%, that means that they're paying out more than they're actually bringing in. So again, when I'm personally looking to start a new investment into a REIT, I like being in that 70%, you know, or as low as I can get it, essentially. Just because, of course, it just makes it that much more safer of a distribution. So me personally, I honestly wouldn't be surprised in 2024 to see a reduction in their payout, unless their Q4 financial report has stellar progress. Like I said, I could see this being a problem in the future here. Again, looking at their revenues from rental, they actually do have a good increase. You know, they went from 598 million to 623. So that's obviously what we want to see. We want to see their leases expiring and renegotiating for higher rates, which is what this is obviously going to be a result of. Also, too, I can't remember if they had any new developments come to completion. If that is the case, then obviously that would also be increasing their revenue from rentals as well. So again, these guys are paying around that 7%. So if we did see like a reduction to like 5 or say 6% distribution or a dividend, I do believe that will help rebuild its capital loss that that was seen majorly from 2023. So 2024 could be somewhat interesting for SmartCentres. So we'll have to stay tuned and see what happens here. So moving into the next guy here, obviously RioCan. This guy is, I think, the best positioned for 2024, and we'll kind of get right into that here. So again, looking at their payout ratio, from September 30th of 2022, they were at 64%. And of course, the September 30th of 2023, just being shy of 70%. Now, if you guys aren't familiar with RioCan, they did reduce their payout ratio. I think it was 2021 or maybe it was 2022, but they did reduce it. These guys are paying in and around that high percentages of like about 5.9, or maybe it's achieved 6% at this point. So they are kind of going into, they went into that direction that I believe that Plaza REIT and SmartCentres are going to have to do. But of course, RioCan did it much sooner. So I do believe that they're going to be in a much better position come 2024 here, to reap the benefits of coming in with lower interest rates. So again, the only concern I see here is the revenue has dropped off, which is, I haven't done an investigation as to why. But of course, in 2022 being at 907 million, and then 2023 being at 826 million. So, like I said, I'm not exactly sure what has happened here. I haven't looked into it myself. But yeah, so that was kind of something to be cautious of. But with their dividends, I do believe that they are very safe. So yeah, so anyways, with those three REITs, I will be doing kind of a recap video once the quarter 4 report or the financial year comes to an end for them. Doing another video on that just to kind of recap on going over their performances. But until then, we'll have to just sit tight. So at the start of this video, I did talk about how I was potentially going to be making some changes. Now, one of the things I've learned over the course of my do-it-yourself investing is I personally am not as good at picking stocks compared to the professionals, and and that makes sense. I'm just a bi-weekly investor, but it is also fun at the same time. So I understand the need to play a little bit. But looking forward, I can see myself maybe shrinking down on the REITs within my portfolios and actually moving more just into an ETF. And the reason being is that I don't necessarily have the time to do the deep dives into every single individual holding that I have. Just for the example of, I don't know why the revenue has dropped off for RioCan. I just haven't had the time to look into it. Now, one of the things that I've been looking into is this investment group ETF here by Middlefield. Right now they're trading at $12, and they also pay a high up on like the 7th percentile of a dividend payment, which I find very interesting. I haven't done any due diligence on this yet. This is very high level. This is just the one that I'm currently looking into. So I just kind of want to bring it up to you guys just so you can also maybe have the chance to look into it yourselves if you're considering on getting into real estate investing, right? So I do find that their management fee is quite high though, which is kind of unfortunate, but this is, from my understanding from the high level of research I've done so far, is that this is more of an active ETF where they're constantly making changes and massaging it, which would explain why the management fee is higher. It's not very passive at all. The monthly distributions is a 7.5 cents. So just so we can get the actual payout for everyone here, 12, divide that by $12. So yeah, 7.5% is what they're paying out annually, which is pretty awesome if it's obviously sustainable. I also was kind of looking at their performances. So their year to date was positive 0.85, which I thought in the year that we were in was actually pretty good. And their 10-year being at 6.68. So one of the things I want to point out too is that this one is a bit more diversified, right? When you look at my real estate currently being Plaza REIT, RioCan, and SmartCentres, I'm very centralized in Toronto and in the commercial real estate, right? So the nice thing in regards to this particular ETF is that you're kind of getting a lot of other exposure, right? So multifamily residential REITs, right? We're getting retail. We're getting the industrial, which actually has done very well over the last little while, right? Healthcare, so on and so forth, right? So I just kind of wanted to point this one out. It's also diversified a little bit, right, in regards to the geolocation. So it's 70% in Canada, 26% in the US, and very small 2.5% international. So like I said, I do find this one quite interesting. I did do just kind of a back test, and I kind of wanted to share it with you guys. So what I ended up doing here is this isn't like a portfolio that I would make, but I'm just using it as a comparison. So, because right now I technically hold 5% of Plaza REIT, 5% in RioCan, and 5% of SRU, or sorry, SmartCentres, in my overall TFSA and RSP portfolio. So what I did here is I just took 33% because I can't do the back test unless it equals 100%, and I just compared it to the Middlefield ETF, being is a single ETF at 100%. So you may have already saw it here, but again, their compound annual growth rate over the last 10 years, and this is based on from 2013 to 2023, has been 6.27%, compared to my stock picking being at 3.06%. So I find that kind of interesting. Now, their best year obviously comes from the individual stock picking. But the worst year was actually very close, which I actually thought was quite surprising. So that's maybe a little unfortunate. I would have liked this to have been lower, because I'm trying to think that this is maybe a little bit more of a safer bet versus the individual stock picking myself. But we'll have to wait and see. So yeah, looking at the annual returns, obviously you can kind of see the differences between the 10 years. And so last year, if you were to combine all of them together, negative 12% on the 3 individual REITs compared to 0.29%. And again, you can see the differences between the 10-year and the 5-year and the 3-year. So like I said, I'm kind of liking this one personally. The distributions are more compared to the 3 individual stocks that I have picked out myself. So like I said, RioCan is paying on the lower 5 percentile right now, whereas Plaza REIT and SmartCentres are in that 7%, whereas this overall ETF is in that 7.5 percentile for payment. And again, diversified. So out of the portfolio, I think RioCan was 3% over this entire ETF. So for example, if they had to reduce their distributions again, say from 5% down to 3%, we're not going to feel it too much, right? Because of course, this particular real estate ETF is very diversified. It has a number of holdings, etc. So I'm gonna do a little bit more due diligence on this ETF myself to kind of get a better understanding of what it is. And I'll share it with you guys when I do have kind of my research compiled. But I could see myself potentially not investing more into the individual REIT holdings and maybe morphing it into this ETF. Now, one of the things though is I'm not necessarily convinced that I want to sell the ones I have, because I do feel that when the interest rates start going down, they're gonna pop, I think, very well, and I don't want to miss out on that potential growth. I'm not, some people might say, well, sell because they're down, but I also don't believe that these individual REITs that I am currently holding are problematic, right? The entire industry was down. All of REITs were essentially down in 2023. So unless, like, let's say Plaza REIT was showing signs of like problems within their financial reports, that's a different story, right? But all the real estate REITs have gone down as kind of a whole sector. So it's not that there's any individual problems with the ones I currently have. So that's kind of why I feel like I might hold on to them for a little bit and kind of see how things play out in 2023. 2024. I gotta get used to saying that and kind of see where it goes. But like I said, I do think my end game is going to be going into this particular ETF. So I am very curious on what you guys think. I would love for you to leave a comment, to like the video if you liked it, subscribe if you're interested in future videos. Like I said, if you're a real estate REIT investor, I will be doing more videos like this on particular REITs, and so on and so forth. So I hope you guys enjoy it, and I'll see you next time.